If you're a startup founder planning to raise money, there's something important you need to understand. Pre-seed, seed, and Series A go far beyond being three different sizes of checks. They're completely different stages of your company, and each one has different investors, different expectations, and different legal mechanics behind them. Now, I've helped founders raise across all three of these rounds as a startup lawyer, and today I'm gonna break down every single one of these rounds so that by the end of this video, you know exactly what stage you're in, what investors are gonna look for at that stage, and what you need to have in place to close the round. Let's get into it. Why startups raise in stages? Before getting into each round, I wanna make sure you understand why fundraising is staged in the first place. Each round is meant to fund a specific milestone that increases the value of your company so the next round can happen at a higher valuation. Pre-seed gets you from idea to product, seed gets you to product market fit, and Series A gets you scaling once you've found product market fit and identified your ideal customer profile. Each stage has its own investors, its own check sizes, and its own expectations. So if you walk into a Series A meeting pitching a pre-seed company, the investor is going to politely cut the meeting short and move on. And if you ask for pre-seed money but refer to Series A concepts, well, you're doing yourself and your company a disservice, and investors are gonna note this. So having a clear understanding of these three stages keeps you from wasting months pitching the wrong investors and losing credibility before you've even got to the round you can actually raise. With that said, the first round most startups go through is pre-seed, which is also referred to as the angel round. This is the round you raise when you're at the very beginning of your company. Usually you're pre-launch or pre-revenue, but you have an idea or maybe a prototype and you need capital to actually build out the product and get something out into the world. The check sizes here are smaller because the risk is at its highest. A typical pre-seed round is somewhere between 50 to 500,000 raised total, and often at a valuation cap between 5 to 10 million. I've heard some people say raising below a $3 million valuation cap is a waste of your time and you shouldn't do it. Obviously, exceptions apply. But let's talk about who's actually writing these pre-seed checks. The most common starting point is friends and family because these are people who already know you and are betting on you as a person more than the business. Then besides friends and family, you have angel investors who are individuals investing their own personal money. You also have accelerators and incubator programs that admit you early, give you an initial check, and provide mentorship and resources. Lastly, sometimes your own customers can be some of your best early investors, especially if they're high net worth individuals who already believe in what you're building. Now, legally, pre-seed is the simplest of the three rounds. You'll be using a SAFE, which stands for Simple Agreement for Future Equity. It's a template contract Y Combinator created back in 2013, and most rounds under 2 million are done with a SAFE. And how it works is, instead of selling shares today, you're giving the investor the right to convert their money into shares later when you raise your Series A or a priced round. Usually you raise your SAFE with a valuation cap and a discount. You don't have institutional investors at this stage, so the legal work is much lighter than what you'll see in later rounds. And that typically means there's no option plan to set up, no board seat to negotiate. The one thing you do need to handle is filing a Form D with the SEC within 15 days of getting your SAFE signed, because if you don't, your investors can take their money back, you can be fined, and you can also potentially be barred from ever raising investment ever again. But beware, using post-money safes comes with a risk. They're easy to use because they're a widely accepted template, but the dilution that comes with post-money safes can be quite unfavorable for you as a founder. By the way, if you want your company legal documents investor ready before you walk into any of your investor conversations, click the first link in the description and book a free consultation with me. We'll figure out exactly what you need to have in place. Anyway, let's keep going. Seed, the product market fit round. The next round up is the seed round, and everything starts to scale up here. Seed is where you've usually already launched and you have a product in market. You might only have a small group of early users or maybe a bit of revenue coming in, but you've shown early proof that your business actually works, and investors are now betting on whether your early traction can grow into something bigger. The amount of money raised at seed is a lot bigger than pre-seed. A typical seed round is around $2 million raised, often at a $15 to $20 million valuation. Now, the type of investor writing these checks also changes. You might still have angel investors involved, but they often are writing larger checks than they did at pre-seed. Now you're also going to start seeing institutional pre-seed and seed funds, which are venture capital firms that specialize in this stage of funding. These are professional investors writing checks out of an actual fund, not their personal money. So the dynamic of the conversation is different. They're going to ask harder questions, they're going to do more diligence, and the bar for what they expect you to have in place is higher in terms of your company legal documents. Legally, seed is also where you start to see things get more serious. Safes might be common for fundraises up to 2 million, and most seed rounds might be done with them, though originally safes were really designed for pre-seed rounds. But you'll occasionally see priced equity rounds at the seed stage, especially if institutional investors are leading. And if institutional investors are coming in, they're going to require you to put an option plan in place. Friends and family or angels at the pre-seed round usually won't make you do that, but institutional investors will. Plus, your legal documents and data room need to be a lot more put together and organized than they were during your pre-seed round, because the diligence at this stage is much more thorough. Series A, the growth round. The third round is Series A, and this is the growth stage round. By the time you're raising Series A, you've found product market fit, you have actual traction, and the money is going towards scaling, hiring a team, and turning what you've built into something much bigger. This is also when most companies bring on their first true institutional investor, which is the venture capital firm leading your Series A round. Now, the check sizes here increase a lot from where they were at seed. A typical Series A is 10 million or more, raised often at a valuation around 40 million, though again, this varies based on the market and your traction. The investor at the table is now an institutional VC firm, and many founders aim to work with name brand funds, often referred to as Tier 1 VC funds, instead of an angel writing a personal check. Tier 1 VC funds are funds like A16Z, Sequoia, Lightspeed, Benchmark, SoftBank, and First Round Capital, just to name a few. Because of how much capital is involved, what the investor expects from you also changes. They want to see lots of revenue, usually around 85K MRR or $1 million in revenue ARR, strong growth metrics, and a clear path to scaling. Because Series A is considered growth capital, investors will want you to have your ICP identified, product market fit clearly identified, and a system for customer acquisition that can be scaled. The bar at Series A is much higher than the earlier rounds because for a VC's model to work, they need companies that can return their fund. Now, legally, Series A is also where things start to get a lot more complex. Series A rounds are priced equity rounds, meaning that instead of using a safe that converts later, you're actually selling shares of preferred stock to the investor at a set valuation right then and there. The deal is governed by a full set of financing documents rather than a single 5-page contract like at the earlier stages. One of the most important of those contracts is the term sheet, which lays out everything that matters about the deal, including how much the investor is putting in, the valuation they're investing at, what rights the investor gets for their shares, and whether they get a seat on your board. And while term sheets are technically non-binding, meaning the investor can walk away without legal consequences, once both sides sign, the deal is roughly 90% locked in because everything that matters has already been agreed to. Now, there are two terms in a Series A term sheet you need to understand. First is liquidation preference, which sets who gets paid first when you sell the company, and the version you want is 1x non-participating. Board seats are also important because once you give your VC a seat on your board, they have direct influence over major decisions in your company. The thing is, the diligence process at Series A is far more involved than anything you saw in the earlier rounds. The investor's lawyer is going to go through every aspect of your company, and if anything is unorganized, it slows the deal, you lose leverage, and it gives the investor a reason to ask for more control to protect themselves. For context, raising a pre-seed or seed with a lawyer typically takes 14 to 45 days from start to finish, but a Series A usually takes 90 to 180 days because of how much there is involved. So by the time you're raising your Series A, the legal foundation you've been building since day one is really put to the test. Now, if you're a founder who's getting ready to raise any of these rounds and you want a lawyer who's done this hundreds of times before, click the first link in the description and book a free consultation with me. We'll go through your specific situation, figure out exactly what stage you're at, and put together a clear plan so the round actually closes the way it's supposed to. Again, you can book that call with me using the first link in the description. And if you're curious when hiring a lawyer becomes necessary, then check out this video next.